So, you want to learn bookkeeping. Special Journals. Lesson 6 by Dave Marshall. Where to go from here? Worksheets and financial statements. Adjusting entries. Okay, so let's take a look and discuss what type of transactions are normally recorded in the general journal. At the end of an accounting period, month per year, the account balances are brought up to date and amounts are adjusted to reflect their current correct balance with general journal entries that are called adjusting entries. An adjusting journal entry is an entry in a company's general ledger that occurs at the end of an accounting period to correct any errors and record any unrecognized income or expenses for the period. Closing entries. Closing entries are entries made at the end of a period, usually year, to reduce the temporary account balances, revenue, expenses, and drawing accounts to zero and transfer the summarized balances to the capital account. All our income statement accounts are going to be set to zero and the net balance, which is actually the profit/loss, transferred to the capital account in the balance sheet accounts. We reset our income statement account, revenues and expenses, balances to zero in order to start over and begin calculating the results for the next new period. If we didn't, the new period would have, not only the results from the new period, but also the results from the prior, older period included. A quick refresher about our revenue, expenses, and draw accounts. Revenue, income, expenses, and draws. Revenues, expenses, and draws are subcategories of owner's equity. Think of owner's equity as a mom with 3 children to keep up with. I know she's only got one clinging to her leg, but she left expense and draws at home. The kids are named revenue, expense, and draws, and each kid has one job that they are responsible for in order to earn their allowance. Kid revenue is responsible for keeping track of increases in owner's equity and kid expense is responsible for keeping track of decreases in owner's equity resulting from business operations. Kid draws has the job of keeping up with decreases in owner's equity resulting from owner withdrawals for living expenses and other personal expenses. At the end of our period, we summarize all our kids' activities and transfer their balances to our owner's equity capital account, MOM. Trial Balance Worksheet. Let's discuss the layout and what information is included in this worksheet. Heading area. Name of the company. Title. Description of the worksheet. Period ending date. Columns. Name and or number of account and other descriptions. Trial balance column with debit and credit columns. These unadjusted account balances for the debit and credit columns are taken directly from your general ledger. Totals are included in the worksheet in order to prove the accuracy of our postings. They prove that our debit balances actually do equal our credit balances. Adjusted Trial Balance Worksheet. Let's discuss the layout and what information is included in this worksheet. Heading area. Name of the company. Title. Description of the worksheet. Period ending date. Columns. Name and or number of account and other descriptions. Trial balance column with debit and credit columns. The unadjusted account balances for the debit and credit columns are taken directly from your trial balance worksheet. Adjustments column with debit and credit columns. The debit and credit amounts entered in these columns are obtained from a review of your business activities to determine if any transactions have not been accounted for. Adjusted Trial Balance column with debit and credit columns. This column is calculated by taking the balance in the trial balance column and adding or subtracting the debit and or credit adjustments in the adjustments column to arrive at the adjusted trial balance amount. After closing trial balance worksheet. Let's discuss the layout and what information is included in this worksheet. Heading area. Name of the company. Title. Description of the worksheet. Period ending date. Columns. Name and or number of account and other descriptions. Adjusted Trial Balance column with debit and credit columns. The adjusted account balance amounts for the debit and credit columns are taken directly from your adjusted trial balance worksheet. Closing entries. The debit and credit amounts entered in these columns are the amounts needed to zero out the revenue and expense accounts. After closing trial balance, this column is calculated by taking the balance in the adjusted trial balance column and adding or subtracting the debit and or credit closing entry adjustments in the closing entries column to arrive at the after closing trial balance amounts. Financial statements are summary accounting reports prepared periodically to inform the owner, creditors, and other interested parties as to the financial condition and operating results of the business. Three basic financial statements or reports are: balance sheet, the financial statement which shows the amount and nature of business's assets, liabilities, and owner's equity as of a specific point in time. It is also known as a statement of financial position or a statement of financial condition. Income statement, the financial statement that summarizes revenues and expenses for a specific period of time, usually a month or year. This statement is also called a profit and loss statement or an operating statement. Capital statement, the financial report that summarizes all the changes in owner's equity that occurred during a specific period. Order of preparation. Because some of the statements use information from other statements, the statements are prepared in the following order: 1. Income statement. 2. Capital statement. Uses information from the income statement. 3. Balance sheet. Uses information from the capital statement. Income statement. The income statement is a formal financial statement that summarizes a company's operations, revenues, and expenses for a specific period of time, usually a month or year. The following types of accounts are used to prepare the income statement. Revenue, also called income. Definition: the gross increase in owner's equity resulting from the operations and other activities of the business. Expense, also called cost. Definition: decrease in owner's equity resulting from the cost of goods, fixed assets, and services and supplies consumed in the operations of a business. The major sections of an income statement are the heading, the revenue section, the expense section, and the final calculation of a profit or loss. The capital statement. The capital statement serves as the bridge between the income statement and balance sheet. It uses the net income, loss from the income statement in addition to the owner's investments and withdrawal to determine the owner's ending capital balance shown on the balance sheet. How the balance sheet, income statement, and capital statement are related. If you compare the owner's equity, owner's claim to assets, for two year-end balance sheets, the difference, increase or decrease, is explained by the income statement and capital statement. Remember, revenues increase equity, capital contributed to the business increases equity, expenses decrease equity, and owner's draws decrease equity. The major sections of the capital statement are the heading, the beginning capital, capital contributed, net income or loss, withdrawals, the calculation of the increase or decrease to capital, and the resulting ending capital balance. The heading should contain the name of the company, the title of the statement, and the period covered by the statement. Balance sheet. A balance sheet is simply a picture of a business at a specific point in time, usually the end of the month or year. By analyzing and reviewing this financial statement, the current financial health of a business can be determined. The balance sheet is derived from our accounting equation and is a formal representation of our equation: assets equals liabilities plus owner's equity. If you recall, this equation is also called the balance sheet equation. What makes up a balance sheet? Assets. Formal definition: the properties used in the operation or investment activities of a business. Informal definition: all the good stuff a business has, anything with value. The goodies. Additional explanation: the good stuff includes tangible and intangible stuff. Tangible stuff you can physically see and touch, such as vehicles, equipment, and buildings. Intangible stuff is like pieces of paper, sales invoices, representing loans to your customers where they promise to pay you later for your services or product. Examples of assets that many individuals have are cars, houses, boats, furniture, TVs, and appliances. Some examples of business-type assets are cash, accounts receivable, notes receivable, inventory, land, and equipment. Assets are listed based on how quickly they can be converted into cash, which is called liquidity. In other words, they're ranked. The asset most easily converted into cash is listed first, followed by the next easiest, and so on. Of course, since cash is already cash, it's the first asset listed. Liabilities. Formal definition: claims by creditors to the property, assets, of a business until they are paid. Informal definition: others' claims to the business's stuff. Amounts the business owes to others. Additional explanation: usually one of a business's biggest liabilities, hopefully they are not past due, is to suppliers where they have bought goods and services and charged them. This is similar to us going out and buying a TV and charging it on our credit card. Our credit card bill is a liability. Another good personal example is a home mortgage. Very few people actually own their own home. The bank has a claim against the home which is called a mortgage. This mortgage is another example of a personal liability. Some examples of business liabilities are accounts payable, notes payable, and mortgages payable. Liabilities are listed in the order of how soon they have to be paid. In other words, the liabilities that need to be paid first are also listed first. Owner's equity, capital. Formal definition: the owner's rights to the property, assets, of the business, also called proprietorship and net worth. Informal definition: what the business owes the owner. The good stuff left for the owner assuming all liabilities, amounts owed, have been paid. Additional explanation: owner's equity represents the owner's claim to the good stuff, assets. Most people are familiar with the term equity because it is so often used with lenders wanting to loan individuals money based on their home equity. Home equity can be thought of as the amount of money an owner would receive if he/she sold their house and paid off any mortgage loan on the property. Owner's equity, or net worth or capital, is increased by money or property contributed and any profits earned and decreased by owner withdrawals and losses. All balance sheets contain the same categories of assets, liabilities, and owner's equity. The major sections of a balance sheet are the heading, the assets, the liabilities, and the owner's equity. The heading contains the name of the company, the title of the statement, and the date of the statement. In account format, the balance sheet is divided into left and right sides. The assets are listed on the left-hand side whereas both liabilities and owner's equity are listed on the right-hand side of the balance sheet. A report form balance sheet is a balance sheet that presents asset, liability, and equity accounts in a vertical format. Asset section listed first, followed by the liabilities section, and finally the owner's equity section.